This content is sponsored by Quantified Funds for educational and informational purposes only and not financial advice. Investors, welcome back a very special guest, Mr. David Jacansky, the CEO and CIO of Quantified Funds, where they have their flagship product of BTGD, their stacked 100% exposure to Bitcoin plus 100% exposure to gold. BTGD is also up quite a bit in the last 6 months as well as all time. So congrats to you, David, on the great performance of BTGD. We're going to provide a full and complete breakdown of the case for gold now, as well as Bitcoin, BTGD, and maybe even Quantified Funds' new ETFs that they just filed for. First question for you, David, is how do you feel about the performance of BTGD as of September 30th, 2025?
I mean, we're very proud of the numbers we've been able to put up in just over 1 year of being live. Our inception was October 15th last year. But most importantly, I think we're really excited about getting there with really as minimal risk as possible necessary to get there. Overall, we've had slightly more volatility than just IBIT alone, even though we are 200% total exposure ETF. We have a new research paper coming out in the next week or two that will break down the up and down capture ratio of BTGD versus IBIT. And what that means is looking at how BTGD performs when IBIT is down and how BTGD performs when IBIT is up. And over every time period, 1 month, 3 months, 6 months, and since inception, we've had less downside than just IBIT when IBIT is down, and more upside than IBIT when it's up. So that means that if IBIT is down 5 or 10%, let's say 10%, we've been down less than 10%. But if IBIT is up 10%, we're up more than 10%. And that really shows the power of stacking. That's return stacking, or also in the institutional world, they'll reference it as portable alpha. And this is a new and unique way to do leverage ETFs that allows you to have a leverage ETF that you can hold. We like to call it leverage for the long run. These are allocators' tool sets to leverage, and leverage ETFs that help you get just a little bit of leverage in your overall portfolio, but not one that you have to rebalance 3 to 4 days a week like you do traditional leverage ETFs. We've said this before with your amazing audience. There's nothing wrong with leverage ETFs. You just have to become almost a day trader to manage them in your portfolio appropriately. Otherwise, it's very much just a random walk based on how the day-to-day markets perform. The phrase people use is path dependency. So traditional leverage ETFs are very path dependent. You can't really just say, what was the price of Bitcoin last year and what is the price of Bitcoin now? And that's not enough information to predict what the 2x Bitcoin ETF will do. Alternatively, because we are much less path dependent, because we have two assets that are uncorrelated and we can rebalance between them, we are much more likely to hit that return of, well, what was gold's return over last year? What was Bitcoin's return over last year? You can add the two together, remove a very cost-effective cost of financing right now, right around a 4.2%. And we should return just around that return. So we will return without rebalance much closer to what you would expect us to, which I think makes this a leverage ETF that is much more usable for the end client than traditional leverage ETFs. Because again, most allocators don't want to have to rebalance their portfolio 4 days a week. And it's not magic. It just means that the responsibility of that rebalance is put on us to do within the fund and less so on the allocator.
To my knowledge, you have 100% exposure to Bitcoin and then the same exposure to gold. Just so I could get this right, because I kind of figured this out, was that let's say Bitcoin goes up 50% and then gold goes up 20%. So since you have 100% exposure to both, it would be 70% minus, cost of financing and probably some more fees. Is that correct?
Yeah, so that's perfectly correct. So if Bitcoin was up 50% and gold is up 25%, you can expect us to be up 75% minus the cost of financing. Right now, that's about 4.2% a year, which honestly is much more cost effective than most individuals can get in leverage from their custodian themselves. So it makes it a really economical, efficient way to get that leverage in your portfolio.
Very quickly, how do you define currency debasement, and what are the keys signs right now, like in terms of currency debasement, because it's important for anybody to know about this topic, especially if they're looking into investing into BTGD?
Yeah, I would say currency debasement is really when all major economies stop trying to solve a way to pay down their debt and are more worried about just inflating their way out of their debt situation. Meaning there's two ways to solve the issue of having too much debt to a GDP on a country's balance sheet. It's very similar to a company, right? If you have too much debt as a company, you can either pay down the debt and spend less, or you can grow your way out of it and have more revenues and more sales and more profits. And it's the same from a country's perspective. So actually, when this current administration first got in power and in this time frame, their goal was to actually cut spending, right? We all remember the Doge task force. The idea was to clean up the government's balance sheet and spend less. But that was so difficult to do. And it's really hard for any elected official to go to their constituents and say, thank you for electing me. I'm going to cut all your funding in half. And that is my solution for you, right? So the administration took a pivot and instead said, we're going to try to grow our way out of it. And that means a more steady level of inflation. We've always had a target rate at about 2% for inflation. And it seems now that the Fed is almost all but admitting that it's going to be reset at 3%, right? That is very damaging for the value of currencies. If you have a 2% inflation rate for 100 years, by design, as our system was built, the dollar is meant to lose 99% of its value over every 100-year period. At 3%, it erodes so much faster. And so, yes, let's hope it comes with this amazing AI boom. We get GDP, we get productivity growth and high levels of inflation, but that's not guaranteed. What is guaranteed is that high level of inflation, that high level of currency debasement and printing from these countries. And so you're seeing more and more all institutions around the world talking about trying to protect against currency debasement. And this really affects the risk off assets in your portfolio because bonds perform very, very poorly in higher interest rate environments on a total return basis. And also their correlation benefits to equities tend to significantly erode when there's much higher inflation. Correlation between stocks and bonds are much more beneficial when inflation is at 2% than it is when inflation is at 3% or higher. And so we're in a world where most of the institutional world is benchmarked to a 60-40. And we think that's being totally put into question because the idea of the 40, the bonds, the ag in your benchmark was meant to be a risk off. If it's not going to act as a risk off, people are going to have to think of a new way to hedge their beta in the equity portfolio. And while an asset like Bitcoin might not hedge the equity in your equity beta every single day, over time, it actually does protect against currency debasement, as does gold.
Despite record central bank demand, institutions hold almost no gold. Why do you think that is, David? And how could institutions buying up gold move the price of gold? Because this is super important since, of course, BTGD has 100% exposure to gold.
The chart you're referencing shows the family office exposure to precious metals at the end of 2023, and it comes in at under 1%. So under 1% of their portfolio was allocated to precious metals. At the same time, they had 22% in private equity and 10% in real estate. And if you want to put this in context to a real live pool of investments, let's look at the endowment space. The endowment space is so over allocated to the private equity world, and they don't want to be. They want to sell. But right now, if you're trying to sell a secondhand allocation in your private equity portfolio, you often have to do it at a significant discount. So they're trying to be less exposed to these asset classes that might not perform as well in an inflationary environment as something like Bitcoin and gold, and really allow room for Bitcoin and gold in the portfolio. Dispute something you actually just said here, where the central banks are not at record allocations to gold whatsoever. They're at record allocations to gold over the last 20 years. So if you look at how much central banks had in gold, let's start back into the 70s and 80s, it peaked at about 70% of their balance sheets were in gold. And to put this into context, why was that? Well, in 1971, we went off the gold standard, and it's our belief it's at that moment when gold stopped being just a store value to a real return generator. And by real return generator, I mean an asset class that can actually outperform inflation and give you a real rate of return beyond inflation. And that didn't happen in the first couple decades after we went off the gold standard, because by going after the gold standard, it made it so much easier for us to print and monetize the dollar and issue more debt. And really anything with a cash flow was leveraged up through debt, right? The percentage of people who had just 20% down on their mortgages in the 1950s versus today is astronomical. Now it's almost common thought, why would you ever put more than 20% down on your home purchase? Whereas then it was just in its infancy stages. And obviously, when you lever up an entire asset class, it's going to appreciate the price of that asset class. So actually, the first couple decades post coming off the gold standard was actually very, very bad for gold and very, very bad for scarcity assets. And that's where we saw central banks' ownership of gold go from the mid 70s, 70% of their portfolio, all the way down to about 10% of their portfolio. So in the 2010s, it bottomed at about 10% of central bank assets were in gold. And now we're at about mid 20s, called 25% of central bank assets are in gold. And that number seems to be climbing at an asymmetric rate. It could, who knows, it's anyone's guess as high as it goes. But right now, 1/3 of all gold mined in this world is being bought by central banks. So my favorite phrase is, well, what do they know? And if you take a step back and you think, what is a central bank trying to do with their balance sheet, especially from some of the smaller economies in the world? Oftentimes what you're trying to do is you're trying to protect your economy from a worst case scenario of your currency being debased significantly. So you'll hold assets in trading partners that you trade commodities with for both energy and food and agriculture. And the concept is, even if our system is eroding, even if our growth drops, even if our currencies get devalued, we still have enough reserves to then go out and buy food and energy so that the people in our economy can at least eat and heat their home, right? At the very least, you'll offer those essential services. And then if you think about the fact that now they're taking that playbook and throwing it out and saying, we have to just go back to gold, right? Because honestly, the US got a little bit drunk on being, quote unquote, the best house in a bad neighborhood and being able to issue all this debt. And we had many opportunities to clean up our balance sheet. But because we were, quote unquote, the best house in the bad neighborhood, we didn't really take advantage of that. And now you're seeing these central banks who, for all of time, have built their balance sheet to allow a last resort to the people in their economies access to food and energy, saying, this isn't working anymore. We need to try a new playbook. Actually, a new thing that just came out, I believe yesterday, was France just said they have a goal of buying 2% of all Bitcoin outstanding in their central bank balance sheet, right? So you're seeing more adoption in both Bitcoin and gold. Bitcoin is in its infancy stages on central banks' balance sheets. Gold is in the mid 20s. It's been as high as the high 70s. I don't think it's going to get up to 70%. But you could very easily see it get up to 40, 50, 55% of central bank assets because there's just no protection in purchasing power holding U.S. debt or other countries' debt or dollar-based assets. So you're seeing central banks drop dollar-based assets significantly in exchange for scarcity assets such as Bitcoin and gold.
Walk me through gold's future breakout, because you have a slide that says that under this framework that gold could trade around $6,000 to $10,000 per ounce, which would be great for BTGD, but also gold investors.
Yeah, if you look at gold's run and some of the bull markets in the 70s and the early 2000s, and you overlay it with this gold run that started in 2024, we're only a fraction of the way there. And that's without this massive currency debasement story. So I think everyone is worried about, quite frankly, we're in a world where almost every asset class feels like it's at an all-time high, gold, Bitcoin, stocks. How do you invest in that environment, right? Gold's move that we've seen so far in the last 2 years is still very minuscule on a percentage basis to what we've seen in the early 2000s or in the 70s. So there is potentially a lot more room to run. And I feel very confident saying the most dangerous phrase in Wall Street of this time is different, right? Because we really have no path out of our fiscal deficits, and we're just going to continue to print. And as I said earlier, let's pray and hope it comes with massive productivity growth from the AI space. But irregardless if that growth comes or not, we are going to have this higher level of printing and debasement for the foreseeable future because there's really no path to clean up our balance sheet. Most of our spending is on interest payments, Social Security and Medicare, and defense. And these are major stalwarts that you just can't cut. And honestly, everything else is just peanuts and small percentages around that. So if you don't actually affect that level of spending on those categories, it's going to be really, really difficult for us to clean up our deficits at any point in the near future. And we've seen other developed nations go to their constituents and say, what if we pushed the age of retirement when you get your Social Security back a couple of years? There were riots in France when that happened in the last year. Nobody wants to receive their benefits at a later date. And it's really hard to think that any politicians are going to come in and really gain favor from their participants in their economy by saying, we're going to just cut all your funding. And that's going to be the way we're going to solve this problem. So that's why we've always viewed Bitcoin and gold as the digital and physical best forms of scarcity to protect against this currency debasement trade.
How do you see the roles of Bitcoin and gold in this fund? Which is the diversifier? Is it like a hedge, growth?
Well, I'll first talk about how they bounce and balance off of each other. When you're looking for assets to stack in a return stack process or product like we have here with BTGD, it's important that they're either negatively correlated or uncorrelated. In this case, Bitcoin and gold have a 10-year correlation of just about 4%. Oftentimes you hear all these pundits talk about diversification, and then once volatility comes, all the diversification goes out the window. It's like US stocks, international stocks are slightly undiversified, but when volatility spikes, they all go down in unison. And that's what we were so excited about with this particular pair, is that the correlation benefits between Bitcoin and gold hold up in the face of volatility, meaning that even when markets get volatile, the correlation benefits between the two hold steady. We have a paper on our website called The Case for Bitcoin and Gold, and on the third page, we show a chart of how gold responds to 15% drawdowns in Bitcoin over the last 10 years. And sometimes it's down 2%. One time it was up as much as 14%. But what hasn't occurred at any of those big drawdowns in Bitcoin is gold hasn't had a massive drawdown. And that's really, really important. So how does this work in your portfolio? Gold can definitely be a diversifier to all assets in your portfolio pretty much at all times. Bitcoin will get some of its correlation from beta assets or the M2 money supply, similar to equities, and some of it from gold as well. So on a day-to-day basis, Bitcoin can show and display a little bit more correlation to broader equity markets. But that's why we actually like this combination, because BTGD is less correlated to equities than Bitcoin is alone, right? And that combination of the two makes it even better of a diversifier to a portfolio versus broad equities.
For stacking, is the case for it more for diversification, or is it for more enhanced return potential?
That's a good question. I would say first and foremost, probably enhanced return, at least in this case. But within the stack is diversification. And the two play off of each other, because where we started talking about leverage ETFs that you don't need to trade and you can just hold, the importance of the diversification between the two assets that are being stacked allow us to create a vehicle that can be bought and held, and that doesn't need to be trimmed and rebalanced in your portfolio all the time. But overall, the concept of this ETF is to provide outperformance by stacking two unique assets on top of each other. And I think gold is a really unique case here, especially for young investors, right? Young investors, every investment decision they make is in relative to equity benchmarks, right? Why shouldn't I be in 100% equities? And anything you want me to add to my portfolio that takes away from equities, hopefully will outperform it. And I fully understand that. And I think that makes it really difficult for young investors to conceptualize allocating to an asset class such as gold. Bitcoin, that makes more sense. It's a higher beta asset. You can expect or hope that in bull markets that Bitcoin will have a higher upside than just broad-based equities. But it's really hard to make the decision as a young investor or any sort of aggressive or growth investor to sell equities to buy gold, which is why we think it's such an amazing asset to stack on other assets, because it doesn't have to outperform US equities in this case. It doesn't have to outperform Bitcoin. It just has to outperform the cost of financing, right now about 4.2%, to be additive to BTGD's return when compared to just owning Bitcoin on its own.
The prospectus says that the fund uses futures and underlying funds rather than direct investment into Bitcoin or gold. Can you explain why you chose that structure and the trade-offs involved with that?
Yeah, so futures is one of the most cost-effective form of leverage in this market. We actually added a sticker to our prospectus that We will now also be able to introduce synthetic options to recreate Bitcoin and gold allocations. So that just gives us another tool and a tool to diversify from just using the futures markets, and also tax loss harvest between futures and the options markets, trying to make this as efficient of a vehicle as possible. We will never have an issue where we have lost Bitcoin in our ETF, and I think that's really important. We're using some of the exchange traded products out there, futures and synthetic options on some of the exchange traded products such as GLD and IBIT to get our Bitcoin and gold exposure. That also means that we don't actually have margin in our account. So we are not going to get margin called, which I think is really important. Getting a very cost-effective form of financing, which I think if you're considering any leverage ETFs, the first question to ask is, what is their financing rate and how steady is that financing rate and how much can it adjust over time? You know, unlike the swap markets, sometimes in the swap markets, things get a little bit wacky, and every day it can be renegotiated what the margin rates are. And sometimes it can look really good and sometimes it can look really bad. And sometimes in very volatile market environments, all of a sudden your cost of financing can skyrocket. That is not likely to occur in either the futures markets or the options markets.
I've noticed that the biggest barrier to entry that I've noticed from investors buying BTGD was that it doesn't pay dividends or have any income component, whether it's weekly or monthly. However, you did file for a lineup of ETFs coming soon that provide dividends or income to investors and even other stacked income products. What are you excited about from these filings, and why did you file for income dividend products?
Well, honestly, it's our goal to build hedge fund-like products in the ETF wrapper, first focus in the crypto space. Honestly, that's always been my mission. I think hedge funds get a really bad name, and I think they get a really bad name for two main reasons. One is the fees are too damn high, right? And two, you can't rebalance that position. So if you invest in a hedge fund and it does what you want it to do and it hedges, and you call that hedge fund, you're just like, you did such a good job hedging. I'd like to take some of my earnings and winnings from this position and reallocate it to VU or the S&P 500. They'll say, well, in 3 months, we'll give you a quarter of your investment back. In 6 months, we'll give you another quarter back. And maybe in 15 months, you'll get the entirety of your investment back. You can't rebalance like that, right? Markets move so fast that the ability to have a hedge fund and ETF is so valuable to be able to make that decision to trim or add at noon and rebalance whatever portion of your portfolio you want. 2 minutes later, I think is such an underappreciated value factor of the ETF world. Also doing so in an ETF wrapper, you don't have performance fees. You have much better potential of being more tax efficient. And so it's our opinion that pretty much any hedge fund that can be put in ETF will be put in ETF, and anyone who holds their strategy behind hidden golden doors, if that is available in an ETF, someone else will beat you to it. And you will lose out on market share because of that. Because an ETF is just a superior wrapper. It is a tax advantage wrapper versus almost any other investment vehicle in the world. At least in the US, we're very fortunate that our ETFs are tax advantaged in the US. That's not the case everywhere in the world. We are launching this new income lineup mainly because we listened to a lot of you guys and listened to what you guys wanted from us. We wanted to create hedge fund-like offerings in this space that you guys find interesting. So we're still partnering with Tidal as a trust company, but we brought a true options team from the hedge fund world in called Convexitas. Their head PM there was with SpiderRock, which was recently acquired by BlackRock, one of the most respected options hedge funds in the country, to offer true institutional quality derivative income strategies in an ETF wrapper. We can't go into great detail in what we're doing here, but what I can say is first and foremost, even though we are going to be making income ETFs, the most important and first primary factor of all these ETFs is total return. So we will not create income in exchange for less total return. Our primary investment objective in our prospectus is total return. I think that's very, very important. Income comes second to total return because it's just not worth it to invest in an income product just for the income if you are sacrificing the total return profile of your vehicle. Out of this 8 ETFs we just launched, 6 are similar to BTGD stacks. They involve the S&P 500, Bitcoin, gold, and treasuries, and all combinations of those 4. So we'll have a stocks and a Bitcoin ETF. We'll have a stocks and gold ETF. We'll have a Bitcoin and gold ETF, a treasuries and gold, a treasuries and Bitcoin, and a stocks and treasuries ETF. And the idea there is to offer income vehicles that, again, with total return as our focus, allow for enough beta on the upside that you're actually participating in the underlying assets actual rally when it moves up. You generate income, so you do have a managed distribution stream, and also offer some form of downside protection, all built into this stacked concept that you see with BTGD, where when there's divergence between the two assets, we will take that as an opportunity to rebalance. And as you've seen with BTGD, that's really accretive in offering higher potential returns and also less risk, because we are doing those hard trades for you and rebalancing between each leg of those stacks for you. So those will come out right after Christmas. The Bitcoin and gold one will be ISBG. Our whole ticker acronym there will be IS, income stacked, and then either stocks, S, treasuries, T, Bitcoin, B, gold, G. It's very, very simple. So the income stack Bitcoin and gold will be ISBG. And we're very excited to bring that to the marketplace. You should expect that to come out just a couple days after Christmas. And the other two ETFs in that lineup are even further into the realm of true hedge funds in an ETF. We call them our MNAV Harvester series. The first is YTSM. Many of you are familiar with a very popular ETF, MSTY. We think they were exceptionally innovative in this space, but if you're willing to add an extra layer of complexity and basically reframe that ETF where it's great to harvest volatility on treasury companies, you don't necessarily want to be exposed to them as your reference asset. So we will still be generating income off of the volatility of expensive treasury companies, but we won't actually be owning them as a reference asset. We will be owning the Bitcoin as a reference asset. And in some cases, when the MNAV falls below 1, we can actually be long those assets. So it's almost like a long short play in the Bitcoin treasury space, as well as a Bitcoin cover call ETF, all wrapped into one. And while that might sound quite confusing and complex, quite frankly, it is. It's truly a hedge fund in an ETF offering. If you ask a lot of issuers over the last couple of years, they'll tell you the third rail of issuing an ETF is complexity. And that's typically been because financial advisors have very short attention spans. And if you can't describe an ETF in 15 seconds, you lose their interest. But what we find so fascinating about the growth of ETFs for individual investors is creators such as yourselves create these communities where everyone wants to learn. Everyone wants to do the deep dive, listen to the research, and collaborate. And I think the collaborative nature of retail investing right now leaves us in a situation where 40-50% of individual investors are kicking the butt of the RIA space because they're collaborating. You guys might not approach a new category with complete knowledge, but give it 9 months, and all of a sudden you guys are all of a sudden whizzes in the options space. And it's so amazing to see that. And so it's given us this chance to take this leap of faith and offer, quite frankly, a little bit more of a complex product that takes a little bit more explanation to understand, hoping that you guys will actually take the time to consider us, do the due diligence on us, and see if this is appropriate for your portfolio.
So we have the future of the income stack series, and then we have, the regular BTGD and whatnot. So what type of investor should own or think about, doing research on the income stack products versus the non-income stack products?
Yeah, I mean, it depends on your need for distribution, right? Like if you are young and you have enough disposable income from your job that you don't need derivative income to supplement that BTGD is the option for you, because you should be worried about capital appreciation above all else. Capital appreciation today leads to even more potential income tomorrow in any form of fashion that you want to get your income later on. But let's face it, we're in a really weird time in this world where 90% of market participants are cash crunched. Their disposable income is either zero or negative, and there's a lot of financial stress that's put on people because of that. So having some form of income in your portfolio that covers some of your payments in life and maybe frees up a little bit disposable income in your life gives you a little bit more freedom, a little less financial stress in your life, can do wonders even in a very young age. And I think a lot of the larger institutions just don't fully get this. It is so hard to be a young participant in this economy when you have very little disposable income and you're worried about any significant wage growth, because at some point AI is going to replace you and your job completely. There's a lot of financial stress involved in that. And so I think people are using managed distribution products to alleviate some of that stress, alleviate some of the pressure of some of the finances that are so expensive in their world, whether it's car payments or rent or a mortgage, etc. I do think you should have some combination of both in your portfolio and not just get overly dependent on just derivative income from the ETF space. And I think you should also consider vehicles that don't just maximize the distributions, because as we've seen, sometimes when you maximize the distribution, the actual underlying value of the asset erodes at a really, really quick pace. And that doesn't really help anyone, because then your supposed income streams are just going to diminish over time. And so we'd prefer to have some stability in our actual income payments, which means maybe accepting a little bit lower of a rate of distribution than some of the highest distributing firms out there. But in exchange, offering you something that has the ability to participate in upside rallies in the underlying market and have less erosion on the downside. I won't claim no NAV erosion. It really bothers me when firms allow individual investors to make claims on their ETFs that they know are just wholly incorrect. There's no such thing as no NAV erosion unless you're a money market fund. Obviously, you have to have an underlying asset that will perform. We do think we're choosing assets such as Bitcoin and gold that will perform over time. So we have the ability to not only have the potential to not have NAV erosion, but also NAV appreciation. But we will never promise you that there's no chance of no NAV erosion, because we think that's just a fallacy that, ETF companies should be coming to you guys front and center and saying, this is a real risk of our fund. So yes, if Bitcoin goes down significantly, you're going to see all Bitcoin related cover call strategies go down, whether it's ones that are doing it on treasury companies or directly on the crypto itself. Like, you do need the asset to perform, and that's really important. That's definitely a risk with all of these derivative income ETFs. We do think Bitcoin, we do think gold, over time stocks as well will go up. But that's definitely a risk that you need to consider when choosing these investments.
Kind of alluding to the future income products, do you prefer a weekly income or monthly income?
Yeah, so we will likely be coming out with a weekly income. That does mean there may be some volatility in each weekly payment. And I think there's going to be a lot of interesting research that comes out in that, basically trying to protect the value of the underlying asset and maybe distributing a little bit less when there are drawdowns. But we will have a lot more information on how we intend to pay dividends after our effective date, which currently right now is December 22nd.
I see that BTGD seeks long-term capital appreciation. So it seems like with these new income products too, that you will be targeting total returns first. So what's so, important to you about long-term capital appreciation, total returns versus, investors who might be looking for income first?
As we spoke about before, if you are focused just on maximum income, you can get these really nosebleed potential yields today, but that only holds up if the asset doesn't erode, right? Oftentimes, you never actually achieve these massive high payout ratios that you anticipate you might get from these ETFs that are paying 60, 70, 80, 90, 100% returns, because a month later, look, every time you pay a dividend on any fund, the NAV of the fund goes down by the dividend. And then it has to appreciate to then be in line to pay the next dividend. So the idea is, above all else, is to offer either capital appreciation without income or the best total return possible that we think is available. Because at the end of the day, if you're not trying to maximize your total return or risk adjusted return, you aren't really running the most efficient form of a portfolio for you. So the goal is to increase your wealth and increase your income streams as you age. But to do that, you really need to focus on realistic dividend payments, realistic income streams now, and not so much on maximizing those returns. So we will have a very healthy rate of distributions, especially because we have these stacks and they're like 200% total exposure portfolios. But each stack on its own is not going to look like 60, 70, 80% distributions, because that's just unrealistic and unlikely to be kept up over years. You're seeing a lot of companies face a lot of fallback from the retail space on reverse stock splits and things of that sort. The hope is to never have to run into that situation as long as you're not over distributing income of your portfolio.
Walk me through the current expense ratio or the total expense ratio of BTGD.
Yep. So BTGD is at 99 basis points, which is a very cost-effective expense ratio for a leverage ETF. We'd like to think about our expense ratio plus our cost of financing. So about a 4.2% cost of financing, 99 basis point expense ratio. You're on about 5.2% with financing baked into that. If you were to buy IBIT or GLDM and add leverage yourself, you're likely going to go way beyond 5.2% in your cost of expense ratio and financing. And so that's where we see the comparison of this actually being a very cost-effective product, even though at first glance it might look like a little higher of a sticker shock than when compared to an unleveraged product.
I've noticed that last year there was one dividend paid out by BTGD. Will that be the case this year, or like what was the thought process behind paying it like one dividend last year? I think it was in December.
So we do our best to minimize capital gains that we have to pay out in the fund, but there likely will be some capital gains that have to be paid out, and currently we're paying that on an annual basis. So we don't have a huge amount of embedded gains in the fund right now, so we don't anticipate it being a massive payout in December, but we will have a distribution to cover any capital gains taxes that you receive by being a shareholder in BTGD, and that'll be towards the end of December.
What makes like your fund for a beginner level investor super unique to own versus beginner level investors thinking, okay, I should just own plain old a Bitcoin ETF and then just a gold ETF. Let's say it's like 5% allocation to the gold one, 5% allocation to the Bitcoin one, that's 10% exposure versus just owning your fund, because some investors think, okay, like I see the high expense ratio. I see that it doesn't directly own Bitcoin or gold, but the performance, of course, is there. So what's your thoughts on investors kind of having that thought process of thinking, I'm not going to look into BTGD because I could just own these other funds outright?
Yeah, I mean, if you only have 30, 40, 50% of your portfolio in equities, you probably don't need any form of leverage or return stacked assets in your portfolio. And you can probably just allocate to a Bitcoin or gold related ETF and be totally fine. The issue is, if you are a younger investor or a more aggressive or growth investor, there's a real cost to selling equities for other assets. So especially as you're young or a more growth oriented investor, you want to keep as much beta, as much equity allocations in your portfolio as possible. So this is a tool to allow you to not have to sell as much equities to get both of these positions in your portfolio and add a little bit of institutional leverage to your portfolio. The hottest trend in the institutional space, especially in the hedge fund world, is portable alpha, which is exactly what we're doing. Portable alpha return stacking is two different names for the same concept. And again, I think it's less of an issue for young people with Bitcoin, but I think a lot of young people fear that if they allocate to gold, it's now at least going to underperform equities over the next 5 or 10 years. And that's going to be a drag on their portfolio. So by stacking, you don't have to subtract as much from your portfolio to get exposure to both of these asset classes. So it's kind of like addition without subtraction, right? You get to add both of these asset classes in your portfolio with selling much less of other things to make room for it because they are stacked on top of each other.
Are there typical portfolio construction guidelines that you recommend? Of course, this is not financial advice. Do your own research when using BTGD. So like, for example, like size of allocation, time horizon, risk tolerance, etc.
Yeah, I'd say everyone's financial perspective is different. So speak to a financial advisor. If you are unclear on this, I think BlackRock put a guide out that Bitcoin should be about a 1 to 2% allocation in your portfolio. There are others that are saying it should be as high as 5 to 10%. I think gold, you can go even higher than your Bitcoin allocation because it's a lower volatility asset. You're seeing many practitioners replace ag or the risk off portion of the portfolio with gold. And I think having anywhere between 2 and 20% in Bitcoin and 2 and 40% in gold is warranted in your portfolio. And you can start to do the math. You're like, well, let's say I was targeting 10% Bitcoin and 10% gold, that's 20% of your portfolio. It might be really costly for a young, aggressive growth investor to sell 20% of their equities to make room for both Bitcoin and gold. So again, BTG allows you to do that in this context. If you're trying to target 10% and 10% by only freeing up 10% of your portfolio. And again, it's really addition without subtraction, I think, is the best way to think about this.
Since Bitcoin is a relatively new asset class compared to gold, how would you counsel or just like say to an investor who is worried about the digital asset side of your fund with Bitcoin for people who might not are still not believe in it and think that it's, too risky and that they shouldn't own it and just maybe shouldn't look at Bitcoin?
Well, the biggest holders of gold in this world are the ones that are starting to accumulate Bitcoin. So I would say if you look at the institutional world and the central bank, the big players who have historically been gold bulls, they're adopting this asset class, not in replacement of gold, but in addition to gold. So sometimes if you're a believer in one asset class, you got to look at who else believes in it and what are they doing out there, and maybe think, why are they doing that? I think it's fine, I think, for Gold Bug to discredit some of cryptocurrencies out there outside of Bitcoin. There is no scarcity in the majority of cryptocurrencies out there. We are big believers that Solana and Ethereum are great technology platforms, but the one thing that they cannot be claimed to have is scarcity profile. So the scarcity profile of Bitcoin and gold make them, in our eyes, so similar. And similarly, as I said, as someone who, owns Bitcoin and wants to add gold, but is worried about like, how do I fit this in my portfolio without selling something? BTGD allows you to just have it stack on top of your Bitcoin. Vice versa, if you're a gold bug and you've been proven right over the last 25 years, gold has outperformed the S&P 500 now over the last 25 years because of this rally we've seen, and you're considering Bitcoin, this is a way to introduce it in your portfolio, addition without subtraction, without actually having to sell something else. So if you trimmed a little bit of your gold position in exchange for BTGD, you still keep your same gold allocation, but you get Bitcoin layered on top. And in that scenario, again, Bitcoin doesn't have to outperform the S&P, or it doesn't have to outperform gold. In that scenario, if that's your perspective, Bitcoin just has to outperform the cost of financing at 4.2% to be additive to your portfolio.
My last question to you, David, is what's one last message you want investors to take away from this interview, whether they are current BTGD owners, maybe future ones, and even those who are excited about the income stacked lineup?
A lot of people worry about how they can potentially try to outperform the market. We all know that it's really hard to be a stock picker and outperform the market. There are some really good managers that offer really good strategies in that space, but an alternative way to try to outperform the market is through structural diversification, right? The best institutions in the world find the best risk-adjusted portfolio and then find the appropriate leverage target on that risk-adjusted portfolio. Through return stacking ETFs, you now have the ability to do that yourself, where you can find an optimal mix of assets, whether it's gold, Bitcoin, stocks, commodities, or any other assets in your portfolio, and add just a little bit of leverage. And that is a way to potentially outperform broader base equity benchmarks without having to be the best stock picker in the world. So stacking diversification is just as powerful as being a fantastic stock picker in potentially outperforming broader equity benchmarks.
Thank you so much, Mr. David Jacansky, the CEO and CIO of Quantify Funds and also the PM of BTGD. Now, if you guys like this video, please give it a like because this cute puppy did. Thank you so much for watching. And once again, this is not financial advice. Do your own research. Investing is risky once again. And check out our last video on your screen. I love you guys so much. Crush on the stock market and take it easy. Peace.